Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. And it's another slightly cautious day for equity markets after yesterday's rise in US inflation, which, coupled with a fairly cautious outlook from Delta in its earnings report, has certainly put stocks on the back foot as we head towards US bank earnings this afternoon, starting off as ever with JP Morgan. Normally the traditional start of earnings season, although with Delta yesterday and Domino's Pizza US yesterday, we've really essentially started earnings season already. But certainly we're expecting some weakness in earnings for the S&P 500 overall, which might cast a bit of a shadow over stocks after their rebound earlier in the week. We then saw it begin to stall on Wednesday and go into reverse on Thursday, and some further losses this morning. Otherwise, it's a slightly quieter morning as we wait those figures. Yesterday's CPI from the US is really, of course, the big event of the week and continues to influence markets this morning. This dollar rose in the wake of the announcement, and market pricing now suggests there's a 40% chance that the Fed will raise rates again this year, having been at 28% before the release of the CPI. The rise in US inflation for the second month in a row does, of course, pour a lot of cold water on the narrative that inflation in the US is on a steady downward trend. Arguably, it still is, and we're just having a bit of a short-term rebound, mainly due to an increase in rents this time around, and maybe that fades next month. But I think certainly 1 month was a blip, 2 months could be the start of a trend, and 3 months would definitely be a trend. So the world does appear to be on inflation watch. Risk appetite wasn't really helped by the fact that Chinese inflation overnight came in flat, and so instead of getting a slight rise in prices, you had a stagnating economy in that sense. So that also didn't really help matters. Hang Seng down over 2%, so some of the higher risk indices really taking quite a knock. Otherwise, it is just JP Morgan earnings this afternoon, the main thing to look out for, really. JP Morgan and a couple of others as well, which then puts us really full on into earnings season for the next 2.5 weeks at least. Starting with indices, beginning with FTSE 100, currently trading at 76.11. You can see really here, those of you who are expecting this market to keep falling will certainly note with some satisfaction that the index, having rallied obviously sharply from the lows last week, down below 7,400, has stalled at the 200-day moving average for the time being. Yesterday saw the index attempt to continue those gains, but then faltered in the wake of the CPI reading in the US, and we've turned down again this morning. So maybe this is a lower high being created following on from the failure for the second time in about 6 weeks to break above 7,700 for the FTSE 100. It was a very solid day altogether in the morning session for European indices yesterday, and they turned lower, and you can see that follow through this morning. Additional weakness below, say, 75.80 would obviously raise the prospect of perhaps another move back down to trendline support, at least from the August lows. The fact that if you're looking at this from a moving average perspective, that you've got the 50-day below the 200-day is really obviously contributing to the view that this is moving from consolidation over the summer into a possible downtrend. Although the fact we bounced in early October from 7,400 does rather dent that view at the time being. Maybe we're still more in consolidation than anything else. And then also watching this carefully, because really trendline resistance coming in not quite perfectly, but certainly you can see that lower highs from into April, and then this big one as well, the September rally, falling back below trendline resistance, and then again today and yesterday does send the message that maybe we're having another move back down, at least towards 74.60, and we'll see what happens then for this index. European markets, of course, are having a really miserable time of it, really, having moved firmly into a downtrend, more or less. I think really it's interesting how that's changed over the past year. Remember, they led the way higher in the first few months of 2023, and indeed in the last couple of months of 2022. Then they peaked. It was a record high, don't forget, for the DAX at the end of July. They peaked in July and then really have been unable to change that tune of decline since then, really. Short-term bounce, as I say, with everything else from last Wednesday, has now brought us back to trendline resistance from that late July, very end of July high, up at 16,500. So people might see further follow through down towards 15,000, and then on really we're looking at a move back towards these March lows, 14,700 or so for the DAX as the next big level of potential support to look out for once we get a daily close below 15,000, because that's what eluded the index at the beginning of October, that we dropped to 15,000 but couldn't close below it, and then buyers slowly began to push this one back up again. It's now started to take on a different aspect here, and of course you've got the famed death cross, on the 10th of October, 50-day moving average crossing below the 200-day moving average, which tends to suggest that maybe we're seeing a change in trend. And that's perhaps what we're getting here with this hit of trendline resistance and then the further losses in early trading this morning. And then on the Dow, again, you're looking for hope that this would continue to fall. Then the reversal at the 200-day moving average would be a fairly classic sign of that, perhaps a slight mirror image of what we saw in May, where the index bounced off the 200-day and then started to rally. As ever in markets, there's always another example. Maybe the point is here that you had in March over around the banking crisis, this huge area of volatility. Really, remember that whipsaws can be quite brutal and quite extended. That we did find a low around 31,500 eventually. The first attempt to hold above the 200-day failed, and then eventually it resolved into move higher. Perhaps that happens again. It's not necessarily guaranteed that the failure to hold above the 200-day yesterday is a negative sign, but it certainly doesn't bode well at the moment. And as ever, price action is the main thing we're looking at. So perhaps further losses back down towards 33,000 or even down to 32,600. Also the thing to watch out for, really. Buyers will just have to sit tight and wait to see whether the index can actually recover and move back above 33,880. If it does that, you can then maybe make a case for why this should continue to rise. But it looks under pressure this morning. Understandably, with the weekend looming, with big earnings starting from today, there's probably not much appetite to push this one too far. So the situation in the Middle East, obviously fluid, could widen, and over the weekend might see some further reasons to be sort of risk averse as the new week gets underway. So it's perhaps not surprising to see indices trimming the gains. It has to be noted that the Dow and others are still up about 2.5% from where we were last week. So it's not a bad rebound. It's perhaps just an extended pullback. We'll see what happens as ever. But it's just worth keeping these moves in context. It was a fairly volatile week to the upside for a change, and it's perhaps not surprising that the week is ending with some of the fabled profit taking. FX markets read the dollar back on top form after that CPI reading yesterday. A second month of gains for headline CPI, even if core CPI remained unchanged or steady in line with the last month, meant that, as we see with euro dollar here, dollar bulls back firmly in control. And it does look eerily similar to what we had at the end of August, a rally back to trendline resistance or a lower high being formed, and then a real big down day, which carried on from there. So that's interesting. We continue to see losses in this direction. Further declines, 104.50, the lows from last week, obviously the first thing to look for, and then below that, and that's interesting because it then puts us well below where we were in January and March. You have to start zooming out again. And down towards, I suppose, potentially area support around 103.50, but really the sellers have been jumping on this one all the way through the past 2 or 3 months. Buyers had a brief moment in the sun this week, but unless they can get this back above 106.20 and back above trendline resistance, it's tough to suggest that there's much more short-term upside in this one. I'm not suggesting that it will exactly repeat what we had in August and September, but certainly that's the previous example, and interesting to note that history appears to be repeating itself for the time being. And last but I see the pound down in early trading this morning. Concerns coming through on news that the government will have to unveil much higher borrowing payments given the rise in yield. So that's not great, obviously, for the UK economy, less money to spend in other areas. So one interesting thing to watch in the upcoming autumn statement. After, again, it's a question of the dollar, really. Rebound and risk appetite generally. Rebound from last Wednesday's lows, got to 123, and again, the sellers back in charge. So if we look perhaps an intraday chart just to get a sense of where we are here, you could argue maybe it's just a pullback after this big rally over the last week or so. If that is to be the case, I think we'd like to see it stay above that 200-hour moving average, back above 122, and then try to sort of claw back some gains above 122.50. It certainly is quite tough at the moment. Broader gains would require a close back above the 200-day moving average, really, just to give us a line in the sand. And as ever, you can see the 50-day moving average declining rapidly towards the 200-day. So no death cross just yet, but potential death cross here, which I suppose gives us a mirror image of what we had at the beginning of the year, where we had a golden cross and then the price rallied, although it did follow up some volatility in February and March. So definitely a tougher outlook for the pound as well after the recent strength we saw last week. There's no stopping the US dollar. Back knocking on the door of 150 again. Remember, that was the level last week, at the beginning of last week, where we finally had not intervention by the Japanese authorities, but from what we could tell, they essentially rang up some dealing desks to try and just point out gently that it was approaching 150, and that was enough to cause that brief volatility. But without any actual intervention, it's proving impossible to keep dollar yen from heading back towards 150, drawn to it like a magnet, moth to a flame, if you want to mix metaphors. So that's the thing, firstly, to watch. The close above 150 is an interesting development, and then a spike towards 152. Remember, the last time we were up here back, indeed a year ago, we did move above 150 and then we're knocked back again, and that marked the top and the start of a huge drop. I'm not suggesting, again, history repeats itself, but it's notable that the buyers are going to have to reassert control here and take it back towards 150. Unless we see it close back below 148, which might suggest that we get maybe another short-term retracement. And in that event, the key area of support is around 144.93, 150, 145, really, where the price topped out at the beginning of July and where we found some support on the way during the course of August. Commodities have come storming back from a tough start to the week, even oil prices picking up after a slightly weaker midweek period. But looking at gold, for starters, huge surge, unsurprisingly, safe havens, slightly redundant expression really, but gold surging after taking a terrible beating in the second half of September thanks to that rise in yields. Nonetheless, we had a lower high this week. This rebound merely could easily fall into a lower high category. In fact, we could all go all the way back if it was that elegant towards 1912 or so, and we'd hit trendline resistance from that July high and it'd still be a lower high. So it's a question of saying how overstretched the price was. Last week, it's like an elastic band, it snapped back towards the 50-day moving average, but we're very much in lower high territory if you get any kind of weakness, certainly below 1900 and probably below 1910 as well. Tough outlook for gold bulls. Once it's back above 1920, maybe they can rest a bit more easy, but there's a lot of work to be done before that happens. And it could be the case that we see gold then struggle into next week if the dollar continues to strengthen. And finally, oil prices. Huge update, up over 3%, and it's not even 11 o'clock in London. Very impressive recovery here, catching people on the hop. Volatile week, really, and this is the frustration of markets. Sometimes you just see buyers and sellers really battling it out in real time. There's no sign that one side yet has the definitive advantage, although if the bulls can close this one above a 50-day moving average, that might be a sign that they then have rested control. We could be on the upside once again. What you had this week was the price gapping higher on Monday with news of the conflict in the Middle East, then declining as people thought it wouldn't expand. And then you had Qatar yesterday saying, actually, we might think about blocking gas exports to the West to put pressure on Western governments. So that obviously caused the price to stabilize and then rally this morning. And that's an interesting sign that maybe we'll get further recovery in oil prices at the pullback here, which is still a pullback in an uptrend as run its course, and maybe we then see a continuation of gains. We want to watch though as we reach this trend line, because previous trend line support from the June lows could be tested from below and become resistant. So that is one argument that oil bears might be clinging on to. As we look to the rest of the day, it's JP Morgan earnings the main thing to look out for, really. We get US Michigan confidence this afternoon as well, but it's earnings from JP Morgan and other US banks that really do mark the obvious start of US earnings season in earnest. We'll get more banks next week and it broadens out with Netflix and Tesla, but it will get very busy from here on in, so do be aware of that. We're expecting the Dow to open at around about 33,615, which is a slight improvement on where we were yesterday. Slightly worse than where we were yesterday, down about 15 points from yesterday's week close for the Dow. So US indices still under pressure, although it looks more like caution to wait and see what those earnings come through as from US banks as the weekend begins to loom. But that's it for me. Thank you for joining us. We'll see you again on Monday at 10:30.